Property portfolio update time. We are building a property portfolio to give us $150,000 of passive income. And this session is all about deep diving and a bit of an update, right? We started this property portfolio in June 2024. So this year, about 5 months ago, we purchased $2 million worth of property, and we're going to update you. One of them is subdividable, one of them is a block of units that we can strata subdivide, and the other is a renovation project that we're in the middle of doing right now, and we're creating instant equity through that. And this is called the Oz Property Investor Portfolio, and we're sharing the numbers, the stats. This is your portfolio, this is my portfolio, mainly my portfolio to be honest, along with Jeff, of course, the co-founder of Oz Property Investors. Each week we interview top property experts, so like button, smash it, subscribe. We need more people to subscribe and stuff. We're not getting enough people doing the liking and stuff, so please do it. Please do it. But this session is all about unpacking where the portfolio's at, but also hitting some of those common misnomers in property. Do I need to be buying close to the CBD? We give you real data, real facts that I've never seen anywhere else of why maybe buying close to the CBD might actually be bad for you. Should I be using leverage for my property investing portfolio? And should I be focusing on capital growth or on cash flow? We break through all of those myths. So let's jump into the session. We have 3 purchases. Property number 1, we bought this property in Melbourne in June of this year. The entire purpose of this property is a 3 to 4 bedroom conversion. Why are we doing a 3 to 4 bedroom conversion is because look at the disparity in this region of a 3 bedroom and a 4 bedroom home. It is whatever that difference is between 590,000 and 681.
91,000.
99,000?
91.
Yeah. Okay, there you go, $91,000 difference by putting a wall up. And that's exactly what we are doing on this property. So we purchased this property for $606,000. That took $119,000, $265,000 of $190,265. A renovation we planned, and planning is a difficult one because we've overspent. So we're going to share that number as well. This is the Oz Property Portfolio. This is what the numbers are. So as we haven't finished the renovation, we can't say that this property is worth $680,000. But when it is worth $680,000, we would have created $74,000 worth of value with $20,000 to $30,000 worth of renovation, which then gives us, we put $1 in, we then get $1.50, $2 back, $3 back if we're lucky. So we planned a $20,000 rent. Reno, and then the rent is going to be $19,760 as it stands if we rented it in its ugly Duckling 3 bedroom, 2 bathroom standing point. I just got the property revalued before we did the 3 bedroom conversion. I've got a statement from CBA who says, from a broker, saying that, Joe, this property that you guys purchased, you purchased it for $606,000, is now worth $641,000 because we bought in the right place at the right time. We negotiated it really well and we acquired the asset really well. So already that is 606,000 minus 641. That is $35,000 of instant equity because we bought well, negotiated strong, and got a great deal. Is that kind of anything else?
Yeah, I just wanted to talk to that, Joe, because yes, this is Melbourne, and as we know, and I'll talk to us about timing the market, and we'll talk about the strategy here. We've sort of pigeon-paired out this property portfolio. So there's a couple down there, Victoria, one up in sort of Townsville, which if you've been buying in Townsville, you understand what's going on up there. But so in terms of that valuation, yes, it may seem low. First off, valuations in terms of the realestate.com kind of and those estimates, they're not always as accurate as what they could be, but they're also conservative. Now, particularly in a market where there may not necessarily be a whole bunch of confidence, but there is opportunity, I suppose. So I sort of see this purchase we made was purchased extremely well, and that subsequently you kind of are building in there. But what will happen, I believe, over the next 12 to 18 months, you'll start to see that valuation will start to, you'll see the properties that are transacting now. So there'll be a lag of the valuation. Now, working in broking, I used to see this day in, day out. People would buy a property and they'd be like, oh, but I bought it so well. It's like, well, you have to wait that 3 to 6 months at least. And in a market where, because valuers are extremely conservative, and even your desktop. So you need to see those sales, comparable sales flow through. So I would suspect 12, 18 months, once we start to see the green shoots really sort of take hold in Melbourne and Victoria, but particularly Melbourne, I'm sort of seeing that being a market in 12, 18 months where there's a good amount of potential. Now you need to be careful. So you can't just buy anything. But yeah, that's where I see some value coming through with that particular purchase.
Yeah, 100%. And it also comes down to timing the market at the right point. Do you want to be buying in a market, and what do you need for your portfolio, right? So we have a portfolio where we want to capture all of the growth cycle. We don't want to be buying in a market that's halfway through a growth cycle that's going to give us a boost of 10% in the next 6 months and then maybe taper off. We want to be riding the full cycle because we can afford to do it. The yields are a little bit lower in Victoria, so you do have to factor that in, but it's not actually ridiculous. Insurance rates, like they are in Queensland, regional Queensland, are not as high. Instead of being $3,000 in regional Queensland, in Victoria, it's more like $1,200. And then also council rates as well. This Townsville deal, this is number 2. This is a very different type of deal. We are deliberately buying this property in a hot market, and here are the numbers. With the Townsville subdivision property, the reason why we purchased this one was to do a 1-into-2 subdivision. It's a hot market right now. I would actually probably hazard to say that Townsville is the hottest market in Australia right now. I don't know. Would you agree with that, Jeff? It is. It is so hard to buy in that market right now at reasonable price.
Of course, it's behind Wollongong, but no, I may have a little bit of bias there. No, Wollongong's definitely not the hottest market in Australia. I think it's right up there. I think it's kind of overtaken your Perths and your Adelaide, and yes, there's many suburbs within, and there's many suburbs in Townsville as well. So, for me, although the Geelong deal is fantastic, Townsville for me is probably one of my more favourite because it has that. The Geelong one, which we'll talk about, the Townsville one, though, has the opportunity to really significantly reduce the debt of that property. Once you subdivide it, chop that little piece of land off at the back, and then if you wanted to, or you could even do a granny, there's many opportunities to do that. I would say that's probably close to 480 as well. I think 455 is conservative, and I like conservative, so I like that we've put our numbers there lower, but I think that would sell for 480 most days of the week up there.
Yeah, definitely. I agree. 800 and odd square meter block, perfectly subdividable, easy peasy as. This is a future value add. This is not something that we need to touch right now. We've got opportunities. We've got the opportunity for a granny flat. We've got the opportunity for a subdivision. That's going to allow us to build out.
So we are talking the first core principle to build your 150K passive income portfolio is it's leverage. So leverage, and why it's the 8th wonder of the world. So Einstein said that quote. So he said leverage, and the Archimedes lever. So I'm sort of bringing out all the classics now. So what do you think about leverage, people? Drop your comments. Is it too risky? Are you fearful of debt, or do you get excited when you get your next to loan? Sort of spoiler for next week, I might be getting some finance as well. But no, so leverage, the reason why leverage, it's for me arguably the most important part, or the key benefit of the property as an asset class. And it allows you to amplify that borrowed capital. And depending on, so some people say you need that 20% deposit. So for me, 20% deposit, avoid LMI. LMI, I'm more than comfortable to pay that to get into the asset sooner. But to just to clarify, yes, there is risk when you're leveraging, but to put it this way, if you're able to save a 12% deposit on a 500K property, which is roughly plus your costs, let's say it's between 7 and 80K of your own money, you're able to then leverage into that asset, which is worth that 500,000. If that asset then grows by, let's say it grows by 15%, that's 75,000. And I'm not going to promise that'll happen in the first 6 or 12 months. It'll happen when it happens. But what that'll then do is it'll then give you that cash on cash return of 100% plus. Now, I know it sounds it almost sounds too good to be true, but that is, are you bringing up the Money Smart, Joe? Are you looking at this? There you go.
Yeah. So I just want to highlight the point here of what Jeff is talking about. We put down $407,000 to acquire this $2 million property portfolio, right? We put down $407,000. Yes, one thing to mention is, yes, we are further along our property journey. We have equity, we have cash, we have starting this property portfolio with $500,000. So we are in a far better position than a lot of people, and I appreciate that. But we can't just start with 150,000 and that'll be a boring show and we'll acquire property over 10 years, which we will acquire property over 10 years. But what Jeff is saying here is, look at this return, $400,000 of cash down, and we've increased the value by $200,000, right? That's 50% return on capital from an equity standpoint. So where can we invest $400,000 and get 50% in under 6 months? Because we're using leverage. We're using the bank's money to amplify our return. So yeah, this is what Jeff is talking about here. So if you have $100,000, and again, I know that some of the more experienced investors that have been a part of this community for a long time, I just want to we've shown this before. So let's choose the alternatives. We have $100,000 and we invest that into gold. We invest that into shares. We invest that into crypto. We invest it into something that isn't leveraged, and it doesn't have that leverage that Jeff is talking about here. So let's do that. This is the Money Spark calculator. All those years ago, I put my portfolio into this and I was like, holy shit, I have to choose property as my investment vehicle because there's no other option that can give me this return. So you take that $100,000 and let's just go with shares. My first share was Woolworths, and let's just do that all over again. And let's say Woolworths returned 7%. So year one, my $100,000 at 7% has grown $107,229. Yes, $107,229. So congratulations, we've made $7,000. Good on you. Happy days. Let's roll it out to year 5. It has now grown from $100,000 to $141,000. Year 10 at 7% compound interest, that will double your money. So I have $100,000. I now have $200,000. By year 20, that $100,000 has turned into $400,000. So you've 4x your return. Congratulations. So you can see as the equity continues to grow and it compounds over the top of itself, that accelerates the growth. So, wow, happy days.
So should you focus on capital growth or cash flow? What should we be focusing on?
If you're focusing just on cash flow, you're playing a loser's game because you won't be able to grab the equity out and then go again. So I've, I think, got a little slide here that's going to kind of talk to things a little bit more. We have two properties here, and what we're going to do is called property A and property B. So we are going to go out there and buy this property here at $600,000. So it's $600,000, and it is going to give us a yield of $520 a week, right? Property A is going to give us $600,000. It's going to be $520 a week, which is a 4.51% yielding property. Property B is going to go off to a mining town. Now, mining towns have a lot of fly-in, fly-out work, and those towns don't really have a lot of accommodation. So what happens is a big mine opens up and they need 500, 800, 1,000 staff members that are all moneyed to the gills. These people you're going to an area that has, medium income of $60,000, and all of a sudden these big mining people come in here with $200,000, $300,000 incomes. They can afford to push the rents up, and there is no more supply of stock on the market, and then rents boom, right? For a period of time while that mine is open. And this is why you need to have the economic economics of the area need to change. So anyway, changing all of that. One property, $520 a week. Second property, $800 a week, right? One is 4.5% and the other is 6.93%. On paper, that's $27,000 a year in rent for our property A. Property B is going to give us $41,000 of rent. Expenses is $11,162 for property B. Property C is $12,000. So everything's equal except for the everything's equal, but property management is a little bit higher because the rent is a lot higher. So if we look at these two properties and just focus on a cash flow perspective, property A is losing $13,000 a year. Property B is giving us $472 a year. So focusing, if we look at all things being equal, and these are the only numbers that you're looking at, property B in the mining town is the better option. However, when you start to increase more variables, that's a $13,300 difference. But let's now look at the growth rate. How much capital growth will that property and that market have? Property A now is going to grow at 7%. Property B is going to grow at 3%. That on property A is $42,000 of capital growth. Property B, it's $18,000 of capital growth. So what that means overall from a net perspective, it's $29,000 worth of growth. And then this one has
it's a little bit closer.
$18,000.
Team cash flow is not going too bad, but you also, I mean, this is a simple example because you haven't factored in negative gearing, have you, Joe? And negative gearing is a dirty word, but you haven't factored in negative gearing, have you, in this one?
No, we have not focused in negative gearing, but we also haven't focused on the tax that you pay on the income that you're getting from property number one. So capital gains, the beauty. So why are you telling me all of this, Joe? So this is why, because capital growth is the most important thing when you're starting out a portfolio. You need to be able to grow that property's value so that you can continue growing again. So right now, this property has $29,000, $30,000, $40,000 worth of capital growth. You can then take that equity out eventually, let's say 2 years, 3 years, 4 years time. You can take that equity out and then go again. For property number two, at the $18,000, it's going to take a lot longer. It's going to take 6, 8, 10 years before you get that capital growth to be able to go again. Also, capital gains is not taxed. So there is a thing called, capital, not tax, financial advice and all that stuff. Capital gains when you sell a property is taxed, but when you pull out equity, that isn't taxed. So you can take the full equity whack out. So rather than needing to sell the asset and go again, you can take out your capital. So you're not taxed on the gains, if that makes sense. So you've got to use the equity to be able to then go again on the next one. This is how people win. The other point that I want to make is, right, you need cash flow to be able to borrow more. So everything in life is a balance. You need both cash flow and capital growth in the portfolio. So why you need to balance the portfolio is if you have a $2 million property portfolio that's bringing in $75,000 worth of rent, that's a 3.7% yield. That's maxed you out. You can't borrow any more money. If you've got a $2 million property portfolio with $150,000 in rent, hypothetically, this is all just a hypothetical, that's a 7.5% yield. That allows you to borrow more money. So the cash keeps you in the game. The borrowing and the equity allows you to keep pushing forward, but the cash is the thing that gets you there. So the capital growth leads to the equity. The more equity that you get, the faster that you're able to save. You're not actually saving a dollar. You're saving equity by growing the property portfolio. That leads to more growth, which allows you to get to more equity. And that is why you don't focus on capital growth. That's why you don't focus on cash flow and why you need to consider capital growth as the key thing. However, if you can borrow $2 million and go out there and buy a Bondi apartment for $2 million and get a 3.5% yield, that is heavily cash flowed, and that's going to eat into your borrowing ability and your serviceability, and you won't be able to borrow anymore. If you go out there and try and find a 4.5%, 5.5%, 6.5% yield in good growth markets, 6.5 is a bit too aggressive. To be honest, I would be focusing more on the 4.5 to the 5.5. you will be able to continue extending and building a portfolio potentially. Not financial advice and all that. Okay, so what do we look? 22 Malaga Street, Kerwin in Queensland. So this is a Townsville property. This is a property that's kind of close to where we bought our Townsville property.
It is, yeah. So zoom in a little bit. So if we go back in time to 1993, so if we look, this person who bought in November 1993 bought it for 193,000. And now, yes, we'll throw a disclosure and just 135,000. I was looking at the 2019 one. And then in 2007, so Townsville absolutely went through epic precautions boom from about sort of 2002. I would imagine if they sold that in 2002, it would have sold for about probably 190,000. But between that sort of 2003 to 2007, it absolutely went gangbusters. So it was then sold for 330 in 2007, sort of, let's say 13 years later. And then it's transacted again 2 years later for 335,000 in 2009. So now what happened? And yes, there may have been a favorable purchase. There may have been a distress in that. So there's always those kind of unknowns that you don't know about the situation. But I think that having looked quite closely at the Townsville cycles and the way it worked out. So around 2009, end of the GFC, it's not end of the GFC, the sort of fallout of the GFC, it really started to just sort of, the bottom started to fall out of that Townsville market. So that person who purchased it in 2009, 10 years later, almost 10 years later, sold it for 192,000. So that is a loss of over $130,000 in 10 years' time. And the interesting thing as well is, so this person who picked it up, and they must have been almost filled. If they were looked at it could have been an owner occupier, but the person, so just over 4 years later, in November of last year, of 2023, they sold it for 400,000. So essentially more than doubled their money in just over 4 years. So to me, that's over 100% growth in 4 years. And a lot of that growth would have probably happened from the end of 2021 to the time. So they would have seen close to 50% growth almost year on year from 2021. And now that asset, if you go up, I think that's estimated at about 520 roughly. Let's skip through the Logan one. I don't, because otherwise we'll be here all night. Let's go to, because this is the hot topic is
Bacchus
Victoria.
Marsh.
Melbourne, Bacchus Marsh. And people would argue that Bacchus Marsh is not Melbourne because it's the other side, Western Melbourne. So if we look at this example, and if I'll describe it. So 1987, I'm just going to, from 1987 to 2005, it close to tripled. It went from 63,000 to 155,000. So that's just under 20 years, so 18 years. So that sort of, and then from 2005 to 2017, so 12 years, so kind of almost two cycles, that it more than sort of doubled. It close to tripled actually. It more than doubled. It kind of 1.5 times. So you made the interesting thing from 2017, so 8 years to, it was sold recently as last weekend. So in 7 years, it's done 45,000. So let that sink in. That is less than 10,000 per year. Which I mean, to
Absolutely
me would be
terrible.
Yeah, and you sort of say, well, yes.
The thing, like in 2017, if you bought that in Perth, if you invested $400,000 in Perth, it would have done a very similar thing for 3 years. But then that property of $400,000 now invested would probably worth about $800,000.
We've got an example.
You've done that in Victoria because you timed. Oh, do we? Oh, but you've timed the market incorrectly, and you've bought in a market that was on the down, and you've sat there for 8 years and not got any growth at all. That's a sad story. Okay, cool. Do you want to go to the Perth one then?
I just want to highlight, I suppose for me, going back to that Victoria example, you sort of look at that and you say, well, yes, they've done that and all that sort of thing. I want to say that the challenge with selling or trying to time, it's not to say, because somebody came up with this suggestion. They said, well, is your thing to not buy a property at a certain time and then not sell? It's like, well, it depends on what your purpose of buying is. It's to sort of look at the data, look at the metrics, and then sort of understand where a market likely sits. This one was first transacted in 2004 for 275,000. And then 8 years later, it sold for 400. This was getting close to the perf boom. The perf boom ending. So it's sort of starting to plateau. So it sold for 425,000 in May of 2012, and that's kind of not horrible, but it's kind of just tracking along at 50%. So kind of you're roughly, I don't know, you're sort of 6% per year, 6 or 7%. And then 10 years later, you take a time machine, you go 10 years forward. In February of 2022, this property then sold for $431,888. The person buying it must have just thrown an extra $880 just to say, look, I'm sorry for doing this to you. Because they've literally made, and they've probably lost money. We're talking $6,888 in 10 years. And that would have gone down. I would suspect that would have been probably mid twos at its lowest. And then this person has that's 431,880 in April. So it's transacted again recently. So just over 2.5 years later, 735,000. That's over $300,000 in 2 years, just over 2 years.
431,880, and the new value is 735,000. Imagine being that investor that in was it 12, 24 months? Is it 20?
30 months basically.
30 months, right? 30 months is 70% growth. Yeah, 70% growth in that market, which is potential equity gain of $303,000, which is incredible. That's monthly. Every single month it's growing at 2.35% growth. Wow.
Yeah, I mean, and it's not to say that the challenge is if you do sell, yes, or if you sort of, the problem with trading property is you're interrupting that compounding period. So I would say, why not do both? Why not do your best? You're never going to pick the bottom of any property market, and you're probably not going to pick the top either. So I would sort of say it's absolutely vital to really, if capital growth is a focus, I would say it's important you sort of take a more sophisticated look at your property investing and just say, all you need to do is look at some core metrics, which we're going to talk to sort of a bit later. But yeah, that's kind of, just let that kind of sit home. And it's not to say that you should go and try and time every purchase, but timing is important. Time in is important as well.
This is one of the biggest things that we hear all the time. It is like, no, I want to buy close to the CBD. I've done the data research over different periods of 10 years, 20 years, 30 years. There's no correlation. Property grows at a similar value. It kind of fluctuates a little bit over the long period at the same rate of return, right? So property grows at about the same. It's kind of around that in between 6 and 7% for property investing, right? So what happens is there are periods of absolute growth and boom, right? So we talk about Townsville, and actually this Perth option that Jeff just had. Perth had a massive boom, and then there will be a period of stagnation where it will flatten out. And then over that 10-year period, it's like, oh my gosh, you just had 70% growth. Yes, there'll be periods of where it drops off and drops off, and it will, over the 10-year, 20-year period, be at that 7%. So sorry, I don't know what that has to do with buying in the CBD. So anyway, looking at the data over the long term, there is no correlation between where the property is purchased over the long term. So one thing that I've done over this little time is pull through all the data, and it took a little bit of time, but I want to show you guys what happens when you buy a property close to the CBD because it's like 0 to 10 kilometers. I want to buy as close to the CBD as possible because that's what's going to grow as the most. Now, the other thing I hear people say all the time is like, well, yeah, Joe, that's all well and good, but how come, this property in the CBD is more expensive, and is it $1 million? And this property, 40 kilometers away, is it $500,000? And this one's at $2 million. Because it started that way, because that property market was more expensive because it was in the economic center where all the value was getting created. Land soaks up the economic value that a community creates. That's what property investing is. So that's one thing to just point on. But let's just have a look at this chart because it's probably going to take a little bit explaining. I sent this to Jeff and he was like, you can't share that chart. It's very confusing. And I'm like, no, I can explain it. So please give me a shot. So along this bottom line, just exclude all of this bottom lines, these 4 lines at the bottom, because you can see over a period of time, we have growth over a month, growth over a quarter, growth over 6 months, growth over a year, growth over 3 years, growth over 5 years, and growth over 10 years. So this is data for WA. So how much growth over 10 years based on the x-axis is how many kilometers away from the CBD. So this property here, this location here, between 0 to 10 kilometers, and then 10 to 20 kilometers, 20 to 30 kilometers, 30 to 40 kilometers, 40 to 50 kilometers, 50 to 60, etc., etc. So it then expands out. So should I invest my capital in the CBD because that's going to give me the most amount of growth? If we zoom up over the short term of 3 years, no, you should not. Over the past 3 years, 5 years, and 10 years, the short-term growth has actually, the CBD locations between 0 and 10 kilometers have been outperformed by most other markets, except for anything beyond 90 to 100 kilometers. The markets that have done the best from a capital growth standpoint are 20 to 30, 30 to 40, and 40 to 50. So should you buy closer to the CBD? No, you should not, because it doesn't make any sense. The capital growth is not in the CBD because a $500,000 property it's not going to grow as much. So let's just hang on. I've got an example here where I talk to the numbers. So I'm just going to say, I'm going to just talk about 1 year, 3 year, and 5 years. If you bought a $500,000 property and you bought it in the CBD, the lowest point, that would be at $590,000 over a year. If you bought it in the market that was moving the most, it would be worth $643,000. Over 10 years, that's $168,000 of difference if you bought in the CBD or if you bought in the better performing markets. Not only that, is the capital, the cash flow in your CBD location will be a lot worse. You won't be getting such a great return because you'll be having such a higher cash outflow because the yields in the cities are less. This data is all houses. So it's housing data. So it's should you buy a house between 0 to 10? So this one here is South Australia. So over the last 10 years, if you bought, this has the highest amount of growth, and these little charts are the amount of growth in the median is that the black line in the middle, 20 to 30, 30 to 40, 50 to 60, and 40 to 50 have been the highest growth rates. 40 to 50 and 50 to 60 have been the biggest. So if you invested in a property 50 to 60 away, you would have actually done better. You would have outperformed by a large margin. And it's the exact same story in Brisbane. Like the data for Brisbane is exactly the same. 20 to 30, 30 to 40, 50 to 60 have grown the most out of all of them. I just think that's totally busts the myth of should I buy in a CBD location.